Hello everyone, my name is Pankush Mehra and my student ID is AZZ30144. Today I am going to present a report on an analysis of two basic Australian securities exchange companies and to know which way one should go in investing and which would be profitable. So here I am going to present a report on Catchler Limited and CSL Limited companies, which are one of the two great companies that have been profitable in the last 3 years in Australian Securities Exchange in Australia. The purpose of this report is to analyze, as I said, the different sources of funds used by the selected companies. More emphasis on analyzing the assets and liabilities, which are the basic criteria of balance sheet. It includes the critical examination of liabilities, assets of the companies and measurement basis for their valuation. So further moving, different sources of funds that has been used by those companies are, in case of Catchler Limited, sales of goods and services. This is the basic revenue that a company generates by doing their sales, be it credit sales or cash sales. Interest incomes, finance income, this is a basic form of this type of company. Sale of non-current assets, grant and other income. Grant is a very great opportunity to earn something and you don't have to involve any expense out of for the same. They are however limited to some companies only. They only get the chance if they fulfill some criteria. Sale of property, plant, equipment, loans and borrowings. They are interest bearing liabilities, but one gets instant cash, so it is a great source. Share options exercised, where we give opportunities to the employees and motivate them. In case of CSL Limited, the major source of funds are sales revenues, royalties and license income, other incomes, finance income, sale of property, plant and equipment, loans and borrowings. Further moving, we shall talk about evaluation of sources of funds used by companies. In case of Catchler Limited, most of the sources of funds generates from sale revenues and less funds are generated from interest bearing liabilities, which is a good symbol in economy. In case of CSL Limited, interest bearing liabilities are increasing every year, so this is clear indication that in the case major source of finance is interest bearing liabilities. Interest bearing liabilities, they have to bear interest, and which is a demerit when compared with another company, CSL, which is undertaking profits basically due to sale of revenues, operating activities. Moving further, we shall talk about percentage of funds that is internally generated as well as externally generated by both the companies. In the case of Catchler Limited, as you can see that percentage of funds internally generated has been alarmingly high. During 2007, 84.26. During 2018, it was 89, which rose to 5% steadily. And in 2019, it was dropped by 1.5% approximately. Percentage of funds externally generated in this case was in 2017 15.74%, in 2018 it reduced to 10.3%, and in 2019 it rose to 12.1%. In case of CSL Limited, percentage of funds internally generated was 63% in 2017, 64 approximately in 2018, and 64 in 2019. So we can see that it was moreover consistent, but it was much lesser than the other company. And when we talk about external generated funds, so they were 36 and 35, which also was more or less constant, but it was less, it was much more if we talk about Catchler Limited. Coming now to merits and shortcomings of different sources of funds used. It is very important to know that what are pros and cons when we select some source of fund. We need to be very reliable of any options because opportunity cost is huge. Sales revenues. Sales revenues are generated instant cash and no payback indirectly. Yeah, if we do something, sale revenues, we get instant cash or our debtors increases, which is an asset and good for the business company. Loans and borrowings, we can seek for some support from external parties, be it government, be it financial institutions. Finance income, when we get interest on our deposits on banks, it's a finance income, and that is a great source of revenue. Grant, as I earlier told, that it's not available to every company. However, no repayment is required in case of grant. Government provides grants to some of listed companies. Sales of assets, when we sell assets, we'll get a source of fund and which can be financed later. Share options exercised, it helps to keep valuable employees within companies, but funds generated may be lower. Yeah, in the case of bonus shares, we can provide share and right issues, but they however does not increase shareholders' wealth. Other income, royalty and license fees generates funds without expenditure. So these were some merits and of different sources of revenues. Now coming to different types of liabilities shown in balance sheet and classifying whether interest bearing or not. In the case of Coachley Limited, current liabilities, trade and other payables, forward contracts, loans and borrowings, employee benefit liabilities, non-current liabilities, deferred tax liabilities, deferred tax revenues and loans and borrowings. In case of CSL Limited, current liabilities were deferred government grant, current tax liability. In case of non-current liabilities, again deferred government grant, other non-current liabilities, retirement benefit liabilities were part of the same. Interest-bearing liabilities. In case of Coachley Limited, loans and borrowings were a great source of interest-bearing liability, but in case of CSL, interest-bearing liabilities were the main. Key provisions under Australian Accounting Standards Board 137, provision contingent liabilities and contingent assets. The objective is to appropriately recognize and measure basis for provisions. As we all know that provisions need to be made when we are certain for some amount, and it is due to some past incidents which is reflecting on the balance sheet date. In case of current liabilities, it is not recognized in financial statements, however disclosure is required. Contingent, as we know that accounting rule says that you have to anticipate for all the losses and expenses but not for the profits. So contingent assets are something that it's expected to be a gainful position, so we don't have to record in the financial statements. Identification of assets recorded by selected companies. Current assets, current tax, forward contracts, account receivables, cash and cash equivalents as shown by cash flow statements were part of the same. In CSL company, cash and cash equivalents, receivables, contract assets were part of same. And if we talk about non-current assets, they were plant and equipment, intangible assets such as goodwill, and we need to amortize same in the upcoming years. So measurement basis used by each class of assets recorded: inventories, property and plants, intangible assets and inventories. We follow FIFO, first in first out cases, and it is measured at cost or net realizable value, whichever is lower. Conclusion and summaries: both the selected companies are stable and profitable. Both companies are making incremental expenditure in investment and research and development activities. Dividend payouts are also increasing here for both the companies. Both companies have significant presence in their respective industry. In conclusion, both companies are delivering values to the customers and their stakeholders. So it's up to you. You have to recognize and measure all the merits and demerits before choosing any company. In the last, these were some of the references used. Thank you and have a nice day. I would like to thank my teacher for giving me an opportunity to provide some valuable comments on this presentation. I was much more familiar with the topics, and thank you and have a nice day. Thanks.